we have a fantastic group of panelists today and a lot of ground to cover. So without further ado, let me introduce our panelists. So starting from my far left, Ms. Catherine Leung, Chairperson of Chamber of Hong Kong Listed Companies and co-founder and partner of MizMaa Ventures. Next, Mr. David Wong, Senior Investment Strategist, Head of Asia Business Development Equities at AllianceBernstein, Hong Kong. My next guest needs no introduction, Ms. Bonnie Chan, which I'm sure most of you will already recognize as Head of Listing at the Hong Kong Stock Exchange. Then Ms. Chen Ding, CEO of CSOP Asset Management. Ding serves as permanent honorary chairperson of Chinese Asset Management Association of Hong Kong, and she's also a board member and the Mainland Opportunities Committee convener of the Financial Services Development Council. So thank you all for taking time out of your busy schedule to share your views with our audience. It's been 4 years since our last forum, and back in 2018, conduct issues such as backdoor listing, shell manufacturing, extreme price swings on GEM, headcount planting, and suspect valuations were very much at the forefront of our attention. So the exchange, working with the SFC, has introduced a series of policy measures to combat these issues, and these include revising the GEM rules, imposing restrictions on highly dilutive capital raisings, as well as restrictions on backdoor listings and shell activities in 2019. So the SFC during this time also pushed up a series of policy statements designed to combat these conduct issues. And what we've observed recently is despite the successes of those policy measures in tackling the conduct issues aimed to address, the perpetrators are changing their strategies and their MO, and we are seeing increasing red flags in new areas. So, some of you may know that in May of this year, the SFC and the exchange issued a joint statement regarding how our regulatory approach on tackling some IPO-related misconduct seen in recent cases. So this form of the IPO conduct in question is closely associated with other types of market abuse. So we see indications that the companies that are listed in this manner and the funds that are raised are being used to fund other types of illicit activities such as ramp and dump scheme, which Tom Atkinson will speak about later. Now, what I like to do is to quickly describe some of the common scenarios that we have come across. In the past 2 years, we have come across a number of cases where unusually high underwriting commissions were being paid. And there are indications following our regulatory inquiries that at least a portion of these commissions were being used to fund artificial subscriptions to help the listing applicant meet minimum listing rule requirements designed to ensure that there is proper price discovery and genuine market demand for the shares. In other cases, we saw indications that a portion of these underwriting commissions were being channeled back to the IPO subscribers, effectively giving them rebates on the IPO offer price. We're concerned that these arrangements are being used to distort, again, the price discovery process and artificially inflate the offer price. Another MO that we've come across involved the listing company using newly raised IPO proceeds to make short-term investments in questionable assets, which we suspect are being used as fronts to redirect the proceeds to fund similar schemes, to distort the price discovery and placing processes. Now, the joint statement that issued in May 2021 sets out, amongst other things, the SFC's front-loaded approach to these regulatory issues. In short, we and the exchange are stepping up scrutiny of these cases. And where appropriate, the exchange will use its discretion, and the SFC will use our powers either to object to the listing or impose conditions where we have concerns regarding the authenticity of the placing or price discovery processes. I've spent some time discussing conduct issues, and there are really 2 points that I want to make. A unique aspect of our market is that the vast majority of our listed companies and management are located offshore. So the challenges associated with cross-border enforcement pose a greater threat to market integrity here than for other markets. These challenges also mean that greater onus is placed on the front end of the regulatory process, on regulators' vetting, on rulemaking, and other front-end interventions to protect our market and our investors. The second point that I like to make is that the perpetrators who are looking to take advantage, to abuse our system and take advantage of our investors can be incredibly well-resourced, and they're constantly modifying and adapting their strategies and MO. So we cannot afford to let our guard down. In order to protect Hong Kong's reputation as an IFC, which is essential to our ability to pursue new market opportunities and expand the listing platform, we must continue to be vigilant. Now, I know you're all keen to hear from our panelists, so let me set the scene quickly by reviewing some high-level, some longer-term changes in our market. Over the last 20 years, the sectors that produce our largest companies have been shifting from traditional industries such as financials and conglomerates to information technology and consumer, the same trends I see in other markets. Next, we also see a bifurcation trend in that the largest companies in our markets, companies with market cap of 100 billion or more, total about 3% in terms of headcount, but account for more than 60% of market turnover. On the other hand, the companies with market cap of 1 billion or less number 52% in headcount, but are responsible for 1% of our market turnover. I also mentioned that more than 75% of the regulatory actions taken by corporate finance division in the last 5 years related to companies that have market cap of a billion or less. So in Hong Kong, we have always pursued a one-size-fits-all approach to listing regulation. Essentially, the same set of rules apply to our largest companies as well as the smallest ones. And we offer multinational institutional investors essentially the same protection and access to opportunities as retail investors. So a question which I will put to some of our panelists today is whether greater differentiation in our market will be better for companies and better for investors. Now, as we develop plans for the future, we should be informed by experiences from the past. As you all know, the GEM board was launched in 1999 to great fanfare during the dot-com era as an alternate board for growth and emerging companies. The board, GEM, has of course been repositioned twice. On the other hand, the two main board regimes for innovative companies are performing well so far. So the question and the difference here appears to be liquidity, not just at the IPO stage, but also in secondary trading. Now, with that, I'd like to turn to our first guest, Catherine, and put the question to you. What are the main risks and opportunities that you see in the listing for our listing market in the near and medium term?
Thank you, Megan. Good afternoon, everyone. A pleasure to share some of the thoughts here. I'm going to be a little bit bold by saying the following. I think the time may be ripe for Hong Kong to have its NASDAQ equivalent, which may be the NASDAQ for not only Hong Kong, but the NASDAQ for China. And I say that because of two key observations, right? China has made it very clear that they want technology to be driving their future economic growth, and that technological advancement is going to be homegrown and self-reliant and not dependent on the talents or the technologies of other countries. So, you know, the stock exchange has done a very good job in making biotech and fintech, right, something that has been a success on the main board. But technology in this era, compared to the dot-com era, also has many different verticals other than fintech and biotech. Semiconductors, very key to the national agenda, mobility, robotics, enterprise software, AI, the list goes on. And the GBA is very much key and in a sweet spot to support that growth, that agenda for China. And Hong Kong features prominently in the GBA. So if you think about those verticals, right, they need capital to grow. Some are very capital intensive, like semiconductors. Some are less, like enterprise software, but nonetheless, they need capital to grow. The second observation, which marries well with the first observation, is that we have a lot of capital in the system. In today's environment, if you're on the buy side, which I'm on now, the difficulty is not finding the money. The difficulty is finding the good investments. And so you see a trend already of people who are in the public equity markets like Templeton and Capital. They want to invest earlier in the pre-IPOs because they think that this is a bit less crowded and they could actually move in a bit earlier for potentially higher returns. They can take that risk. They know how to assess that risk. And people in private equity, like the Bain and the Carlyles of the world, they want to move into late-stage venture because they think they can go earlier on the risk spectrum. And the people in the late-stage venture want to go earlier in the early-stage venture. So the point here is the capital is not afraid of taking a bit more risk for potentially higher return. So if you marry those two observations, there seems to be a need for, you know, an exchange, a board, whatever you call it, that actually would be able to attract high quality companies with real businesses that are really disruptive, has real markets and customers, unlike in the dot-com era, right? For them to attract capital, and institutional investors seem to want to go in a bit earlier and make those bets as long as the ingredients are there. So I do think that that is a very real opportunity in front of us, but the risk of it is if we don't seize the opportunity, we miss the moment. I do think Hong Kong is at a watershed period at this moment in time. It's, you know, that's an idea. There's a lot of details that needs to go with it. I don't know what the regulators think, but you know, if you ask me what is the biggest opportunity in front of us, but it comes with the risk as well, capturing the two ends, right, and being able to form that exchange in between would propel Hong Kong to the next level.
Thank you, Catherine. David, if I can put the same question to you.
Thanks very much, Megan. I feel like, in a way, my own career trajectory helps me answer this question. When I first joined the sell side of the financial industry in 1995 as a technology analyst, my bosses kept asking me, why don't you move to Taiwan? You know, what are you doing in Hong Kong? But how much things have changed. I think that Hong Kong is today, and this is my personal opinion, it remains really the foremost institutional market for investors in Asia. And I do think that the SFC has provided an excellent regulatory and supervisory environment for that. But as we all want to see Hong Kong's financial markets continue to develop, I would frame both the challenge and the opportunity for Hong Kong in four different vectors. One is liquidity, the second is alignment, the third is governance, and the fourth is sustainability. And these are all things that I think global asset managers care a great deal about. On that first issue of liquidity, I very much agree with Catherine that the time really has come for Hong Kong to consider what types of companies will be needing financing in the future. We also need to recognize that in the last 20 years, there's been a giant amount of capital attracted to private equity and to venture capital, meaning that many companies don't even have to list if they don't want to. But what they may want to do is to list to give their employees liquidity as well as some of their early stage investors. And so I think the corollary of that is that Hong Kong needs to be aligned with those interests and to create a framework that would allow for earlier listing of companies that are still investing for growth and may not be able to demonstrate at least that profit test that we're so used to in the past. I think on the second issue of alignment, we do feel like this has not been a great year for Hong Kong equities, and it's not lost on many international investors that the Hang Seng CEI is down about 17%, while the CSI 300 is only down a few percent. And while some of that is down to perhaps lower business alignment with government policy in China, I think some of that, from the perspective of international investors, is about capital alignment. We actually would like to see continued southbound flows so that we know that Chinese capital actually owns more of this market here in Hong Kong. And so we would absolutely welcome that in future. Just very quickly, on governance, if we take a longer term perspective, we actually sit in a marketplace that has enjoyed incredibly strong GDP growth, and that has provided tailwinds for revenue and profit growth. But actually, if you look at a 25-year history, the earnings per share growth of companies in Hong Kong has not matched, for instance, that, say, of the US market. And so I think there's a continued need for us to improve governance standards in this marketplace to keep it attractive for international capital. And then the final point is something that I think Hong Kong's already making great strides on, which is to promote sustainable investing, both at the retail level and really for the entire ecosystem. And a lot of that really will come to, I guess, labeling, but also disclosure standards that have to be set for companies that list in this market.
Thank you, David. Well, very interesting observations and thoughts from our first two panelists. So, Ding, as I turn to you, I'm going to start by quoting something you once said at an open forum, which is that Hong Kong needs more investable companies. You also commented recently that we need more tradable companies. May I ask you to elaborate on these remarks and also comment on how Hong Kong can position ourselves competitively compared to other investment opportunities that are available to mainland institutional investors?
Thanks, Megan, and good afternoon, everyone. It's really great to be here and to see so many people. Right now, nowadays, there's very real opportunities to see people face to face. Thanks for your good memory, and your question brings me back to 14 years ago, 2007, while I was still in Shenzhen, in mainland China, running first QDII funds in Shenzhen. When QDII introduced to the market, when we the first QDII firms, we were so thrilled. The reason is because we are the first group of people have chance to access to international market, especially Hong Kong market. Why is that? Because, this is the first time as Chinese investors, we have the chance to invest those names we are so familiar with, but we don't have chance to participate, like Tencent, like other, tech companies. Another thing, make us so thrilled, and we see we will be the champion, is because of Hong Kong cheap valuation, H-share cheap valuation. I still remember at that time, premium is about 30–40%. And in my department, we think, we are the winner. Because compared with our domestic PMs, we can, buy things cheaper than them, 30%, 40%, right? So we have slogan in the department say, buy, buy, buy. So buy, buy, buy is from us, not from Chinese, Dama. And we also, because we're doing international business, we convince our institutional investors, like insurance companies, because they hold quite a lot of blue chip stocks, and for longer time, for dividend yield, we convince them to say, why don't you, switch H shares, use H shares, switch A shares, because it will give you more decent, dividend returns. Which is a work. And we also very creatively, try to launch in some products to use, like, for instance, ETFs, to using H shares, replace those A shares, and to try to give the ETF more flavor. And we think the AH premium someday, somehow, will be eliminated by the hard working of us. And but unfortunately, that part is not that success. After 10 years, the price difference between A shares and H shares not narrowing, but widening. But don't quote me wrong. Until today, I'm still, have faith, like, in the future, we will, eliminate this sort of premium and discount. And I will come back a little bit about that later on how we can do it. And so during last session, Julia, as the moderator, we heard companies celebrate quite a lot and for their anniversary. And actually, this month, Hong Kong market, we celebrate the 7th year's anniversary of Stock Connect, right? I can share with you about the Stock Connect. One statistic I think is very interesting is, for over the 7 years, international investors, including Hong Kong institutional investors, we have 1.5 trillion RMB flow into mainland China. Until today, the market cap counts about 2.6 trillion RMB. That means we have like net 1.1 trillion RMB profit, which is fantastic, right? It turns like 7 years, we probably have like 80% of profit. But if you look at deeply about those holdings, you will find out most of the holdings we can trade in Hong Kong. But why we're not trading in Hong Kong? We trade, more expensive A shares. I think the main reason is about liquidity. So from that, that facts, I think, we can draw a conclusion is people pay premium to buy liquidity. So I think, in order to make Hong Kong a better, or high quality listing market, we have to do something to improve our liquidity. I know for years, because I have been with the market for more than 10 years, we have improved liquidity dramatically. But I think we still have room to go. And when we talk about, high quality listing market, we cannot ignore one specific stakeholder. Bonnie, take care of them quite a lot. Is the company try to list in Hong Kong. So from their angle, from their point of view, they will view a market, what is the high quality listing market. I think there's three things they will look at it. First is how, to get a desirable valuation. The second is to, in a relatively short period of time, to gain the listing approval. I think from that part, I have to give Bonnie and her team a lot of credit, because we're the champion of listing market, right? So you guys definitely are champion, world champion. So the third thing, for the IPO companies, they probably will want to do is to using the ListCo platform to facilitate their future business expansion. So if I talk with the IPO companies, I heard from time to time, the most pain point is how to get desirable valuation. I think that one is also related to the liquidity. And Hong Kong is our home market, right? So for us, obviously, we're here. We hope Hong Kong will be a better place. And I think Hong Kong can, definitely can be a better, high quality listing market. And because this is a SFC, form, I want to say something to regulator and also to exchange. I think for Hong Kong regulators, we have a very robust process. And I think in the long term, in order to, increase market liquidity, probably there's a couple of things we can do from my humble opinion. First of all, we can continue to broadcasting Hong Kong, the advantage of Hong Kong, like we did in mainland China, to tell long-term money. If your purpose is, one of the purposes is to have like a long-term dividend, yield, probably you can use H share instead of A shares. And also, I think invite more investors to come into Hong Kong is also essential. For instance, like retails from mainland, and we have like Stock Connect for 7 years. And we all know that for mainland China's people, investors, if you try to participate in this privilege, you have to have like 500,000 renminbi. So whether we have chance to, to do something on that. And also another thing I think is important is to invite more market makers into the market. And we know, China market right now, Hong Kong market daily trading volume is about like 10% of mainland China A market. But we probably don't know, like in mainland China A shares, right now about 30% of the trading volume is contributed by their market makers, like quant funds. They count on more than 30%. And in US market, we know US market is the deepest market in the world, right? And I heard from one companies, their company's trading volume is counts on like 1/4 of every daily trading volume. So market maker is very important. And I think, if Hong Kong, there is something we can do is try to, do something to make them trade more on this market. And I think one small thing we can do is to increase the efficiency of settlement. So Hong Kong, this is for Bonnie. So like Hong Kong currently, for instance, Hong Kong, we have 3 CCP, central counterparties. As Chairman Lei mentioned, our institutions are getting more complex and sophisticated. So for investors, every day we're holding positions, and most of our institutional investors, most of our positions are offsetting. But because we are facing 3 different CCPs, we cannot offsetting during 3 CCPs. So we have to put more margins and increase our cost of capitals. So I think if we can, do something on those parts, definitely that will help the liquidities. And I still, think, after, we are doing something to remove those things, Hong Kong definitely can achieve a better high quality listing market. Thanks.
Thank you. Thank you. That was very insightful comments. Thank you, Ding. Now, Bonnie, we'll save the best for last. I'll open the mic to you. Would you like to comment on some of the observations and also share your views on where we are, thoughts forward for the listing market, listing regulatory priorities for the year?
Sure, of course, Megan. And thank you for having me. I've been very busy taking notes when, the other three panelists were speaking, and also when Megan did the introduction. I think first and foremost, right, the topic of the panel, of this panel is about, how to make Hong Kong a quality listing venue. And the cornerstone has to be in the integrity of the market. And we all heard Megan's opening about the problems that we had to tackle and, some inherent constraints that we have, in terms of cross-border enforcement and whatnot. I'm confident, at least we're seeing some results of the work that has been done in the past few years, whether it's tackling the shell problem, and whether it is looking at more recent book building behavior, and Julia's team has recently concluded the consultation. So I think we will have to watch carefully whether that's making the intended impact. I don't think I think we need to be realistic. We're not going to be able to curb every single bit of misconduct. But then we have Tom and John in the audience, right? When things does go wrong, they will flex their muscle and take enforcement action. So I would instead focus on actually something that Catherine has started in her speech, has talked about, and I think that is very important, is how do we actually capture the opportunity in front of us, because it's a big, big opportunity. And so, as I listen to Catherine, I try to dumb it down for myself. What are we talking about? What is a listing venue or an IPO market supposed to do? I think it's simple, right? It's really to match people with the money, with the capital, with people who needs the capital. And therefore, if that is the purpose of what we do, and as regulators, Megan and I wants to facilitate that in an orderly manner, then we need to pay constant attention to how the profile of these two camps, right, the investors and the issuers, are changing over time. And if we think about that, we also need to remind ourselves as regulator, we owe it to the market to make sure that our rules and our regulatory regime catches up and it's fit for purpose. Now, if we think about that, and it takes me back to my first time at the stock exchange, I was head of IPO between 2007 and 2010. And life was very simple back then. We have a listing rule 8.05, which is our eligibility requirement. It has 3 tests. The first one is a profit test, so you need a track record of 3 years of profit in aggregate $50 million, of which the last one has to be no less than 20 million. We're raising it January 1st, by the way. And we also have 2 other tests, and those are supposed to cater for the high growth company, and it's a combination of a market cap and a revenue. Now, during my first stint at Exchange, I can tell you that 99% of the companies came via the profit test. It was the gold standard that's supposed to tell investors, if you've made profit in the last 3 years, that's a good indication that, it will be happy ever after, right? That's how we tend to think about things. But I think over time, and I'll ask the experts in the audience, right? Is it really fit for purpose? Like Catherine said, capital are now interested in earlier stage, right? When companies are not even pre-profit, we're talking about pre-revenue. And so if we do not adjust our rules, right, to catch up with the trend, we end up providing our investor with a not very attractive set of opportunities. And so if you think about the journey, 2009, that was sort of my second year, in my first stint of the exchange, we made the first breakthrough. We created something called Chapter 18, which is the mining company, and we allow for the first time pre-profit company, which is in the development stage, to get a listing status. So that was sort of groundbreaking. And then not much action. And then, if we think about more recently, right? I still remember, and I was in private practice at the time, it was not until 2015 or 16 when we begin to see loss-making companies coming to list in Hong Kong. These are tech companies. And I recall at the time the exchange, and I wasn't there, right? So I was on the receiving end, kept asking us, can you show us the path to profitability, right? And we're like, how do we say that? I mean, the company is still growing. But we, do our part, and the sponsors, had all the right disclosures and risk warnings. Then more recently, right, we all know 2018, another breakthrough. We are now admitting pre-revenue biotech companies. And I think, after 3.5 years, a lot of you will agree that that was a pretty successful chapter. So I'm not trying to use this opportunity to propose further sort of relaxation, but I think, echoing what Catherine has said, we just need to see what is the most attractive to investors right now. I mean, the AI companies, autonomous driving, SaaS, SEMIs. I mean, these are companies which probably will need quite a long investment lead time, but before they will get to that level of, first of all, revenue and then profit. Now, the bigger boys, the private equities of the world, they can go in earlier, right? Are we therefore saying that, our, not only retail, right, but the not so big professional investors will have to wait until, they check that eligibility box in our existing listing rules before they are, allow a listing status in our market. I think that's some food for thought there, and we just need to stay challenging ourselves in terms of whether or not our rules are fit for purpose. So I think that's quite interesting. And recently, as I look at my rules, one day one thought came to me, and I'll end with that. Our 8.05, that's the current eligibility requirements, was probably created 3 decades ago. And then if I look around the companies which are trying to get listed these days, right, the interesting ones which Catherine mentioned, I bet you chances are the founders of those companies were not even born when those rules were created. So, I mean, are we going to hang on to those rules to, hopefully try to take care of this generation of companies? I think, we all need to think about how to deal with that, and whether or not we can make some changes. And I think, the other points which David touches on governance, sustainability, were absolutely, I think Megan and I spent a lot of time, trying to get the market on board, the journey, and we'll continue the effort. Last but not the least, Ding Chen gave me a lot of homework to do. We have to make the process more efficient. We heard you, right? Whether this is Project Feeney, which is shortening the settlement cycle, we're constantly looking at the friction in the trading and see if we can make adjustments to the micro infrastructure, to hopefully make things more user-friendly. And listing timetable, it's currently a challenge. I think a lot of the speakers earlier talked about the human capital challenges that we're all facing. We have a huge pipeline. I think, my CEO, Gucho, has, told a lot of you on different occasions that we are handling an all-time high number of applications, around 200 at the time, with a smaller team because of the attrition. And I know, when Megan and I work together so closely, our two teams are working very diligently. So Tim, please, more head counts to Megan. Thank you.
All right, thank you, Bonnie. So I think we have time for our second round of questions, and I'd like to start with Ding. You know, we spent a big part of today discussing Hong Kong's role and in the broader plan. And so I'd like you to just take a couple of minutes and comment on what you see as the role that Hong Kong listing market would play in the mainland's continued integration with global markets.
Thanks, Megan. And we all, obviously we heard quite a lot during afternoon sections about China, Hong Kong's role, integrate with mainland China. Basically, you know, I agree all, you know, the previous panelists' point of view, and I think, you know, Hong Kong is China's international financial center. China is the second largest economy. China equity fixed income market is the second largest equity and fixed income market globally. So obviously, Hong Kong will have quite a lot of, you know, big potentials in their part. And we heard quite a lot about, you know, people all talking about, everybody is talking about gateway. So for years, Hong Kong is the gateway to connect the world with mainland China. I think for a relatively short period of time, longer period of time, Hong Kong will continually to play this role. And because it's like Christmas season, right? People have wish list. So I do have some wish list as well, regards of this. I think Hong Kong, we probably, you know, as a fund manager, as a product provider, when we talk about, you know, RMB internationalization, and Hong Kong as financial, IFC, International Financial Center, probably we can see, you know, in the future, I hope, but I also believe that Hong Kong can provide more RMB dominated, RMB products to global investors. Like RMB, we talk about RMB equities, RMB fixed incomes, RMB ETFs, RMB, you know, mutual funds. And with those products, we can create RMB offshore liquidities here. So make international investors get more easier to access to mainland China. And also, I think here, I would say actually it's Aboni inspired me. So I think China right now is the second largest economy. And currently Hong Kong, we serve global investors. We mainly serve institutions. We sell them to serve global retail clients. But if you look at US market, you will see US market not only serve global institutions, but also retails. I heard a number, it's really, I'm shocking. It's like one of my friends told me, say, Tesla, right, listed in US, say, probably one day, I would say, one day, like Chinese retail through one individual companies to trade Tesla is like counts on Tesla 30% of the turnover. So I think someday, somehow, you know, our Chinese market probably, you know, 30% of our Chinese make a name like a merchant bank or ICBC. It's like a turnover is traded 30%, 40% is by US retails. So how Hong Kong, you know, we can facilitate those part of business. So I think Hong Kong, we need to be more bolder and also to have more ambitions to achieve that. Thanks.
Thank you, Ding. Now, Catherine, I'd like to come back to you. I think we hear a lot of agreement with your ideas on this panel regarding a platform for new types of company. So, you know, I'd love to hear your ideas. So given, you know, our past experiences with GEM, with the new chapters for innovative company on main board, right? What is the secret sauce? You know, what would make a new venture, whether it's a board, a platform, or just simply, you know, the concept of innovative companies, what would make it succeed, you know, when other attempts may not have been yield us good results?
Yeah, I'll give it a try. I think I don't want to oversimplify on the difficulties of GEM today, but I do think that it served a purpose. And then I think, those companies, the dot-com companies, actually didn't have a real business plan, or they're not very substantive by and large, most of them, not all of them. And when that didn't sort of work, it's very hard for the board itself to work, right? So thinking about the disruptive companies that we just talked about, those verticals, I think that there are two things, right? I don't want to think about size, big, main board, SME, GEM. Maybe we need to divorce ourselves of that kind of thinking and think, is it disruptive? Does it have a market? Does it have customers and people who would use it? And if these are good companies in that sense of the word, let the institutional investors kind of tell us what they want to see in terms of the attributes of the companies for them in order for them to invest. Maybe it's that and the quality of the management team, et cetera, et cetera. Have it a bit more institutional focus to begin with. But success breeds success. If you have the first IPO of that company in that second or a separate board or whatever, and institutional investors make money, more would be gravitated towards that. Success breeds success. And you will have more companies wanting to list on that exchange. And once it's done its job with the institutional investors, we're all comfortable with that market, then you may actually open the door for retail at some point in time, but do it step by step and not a one-size-fits-all, but let the market speak, because these are the people who are going to put the money in to buy these companies, right? So I think not size, not big and small SME. So I don't want to think about SME in that sense, but once this board is successful, the SMEs would be able to list there as well, actually. You need a board where quality institutional investors want to participate in. One of the issues with GEM is the institutional investors do not want to invest in GEM companies by and large. Not sure, my 2 cents.
Thank you. David, if I can come to you, we just heard what Ding said about it would be fantastic for Hong Kong if we can have a greater degree of mainland retail participation in our market. So the question for you is, do you see any benefit to greater differentiation between different types of investors, so institutional versus retail in this market?
Well, I completely understand the mission of investor protection here in Hong Kong. I think we always need to balance that against the provision of equal access to opportunity. And, I would frame it as, my 10-year-old daughter would probably gladly give up the tricycle to go faster. And I do think, we live in a world where newer companies can often offer significant opportunity for return. And anyone that invests in equities understands that they're taking some amount of risk. So, I think we just need to make that clear. I would encourage, actually, retail participation in the longer term simply because that would add to the liquidity that is desirable for these sorts of markets. I think we have to do it in the right way, and I have no doubt that this will be done thoughtfully in a Hong Kong context.
Thank you, David. Now, Bonnie, we have a few minutes left. Is there anything you'd like to say to round up?
Maybe just to echo David's last comment about sort of investors taking risk. And, earlier when I talk about how, the listing market is to match capital with those ones with capital with those ones who need capital. And so we have to constantly monitor the change of the profile. And that leads me to, I think, my final comment, which is we keep talking about retail investors as if, there is a certain image, right? When I ask you, who are the retail investors, right? Is this the Mr. and Mrs. Wong? But recently I found out that the so-called retail investors, which I always thought is just, a very unsophisticated Mr. and Mrs. Wong, Chen, they have changed a lot too, right? So, I've been asking, for example, right, my friends, and they told me, right, they just sort of, use their mobile app, and what are they buying? They are buying sort of, small stock, and they can buy one single stock in the US. They're buying crypto. They're buying derivatives on these stocks, and it's really quite easy. And are they totally unaware of the risk? I don't think so. In fact, I think given, the availability of information, social media, things are being discussed, and so I think that profile has also changed rather significantly. And therefore, I think that will inform how we as regulators continue to think about how to sort of modify and adjust our rules, right, to make sure that they continue to stay fit for purpose. So, yeah.
Thank you. Thank you. Well, Catherine, David, Bonnie, Ding, I cannot thank you enough for a excellent exchange. I think you've given our audience a lot of food for thought, and I'm sure that many of these points will be picked up in the future. So, one thing is clear, Hong Kong's situation and our markets are unique, and we will continue to work with the exchange to make sure that our listing policies are designed accordingly. So we have run into overtime, and I'm looking, I think we have, we probably have a little time for just one question. I'll see if I can pull the out. Okay. I think we can expect that this one was coming, and I will invite you to answer this question, Bonnie. When will the spec consultation be concluded?
When the SFC gives us approval.
Oh, okay. Good answer. All right. So, well, there's a second part to this question. So, many market participants consider that the entry points for SPAC are higher than what they are in the US. So why are we setting this regime for Hong Kong? Perhaps if you start, I'm happy to go first.
Well, we need to put out a straw man first of all, but the straw man was put together after a very thorough round of self-consultation, so we didn't just sort of pick something out of the thin air. I think going back to Megan's point, and she has emphasized it quite a few times, and I totally agree. Hong Kong is a very unique market in a lot of ways, so I don't think we should just sort of bring the US regime to here and do a carbon copy of it and call it the Hong Kong regime. And I should also say that we have a good track record of sort of creating our own version of these rules, and in fact, they turn out to be quite successful, right? Biotech listings, for example. If you think about the U.S. market, anything goes, right? It can be pre-revenue, it can not, have not even gone through clinical stage, and that's still okay. It's, it's all disclosure based. We decided to take a more prudent or a more cautious approach, and set the eligibility threshold a little higher. It didn't, therefore result in an unsuccessful product. So I think we simply need to take a look at our market and do what we consider the best after thorough consultation. I don't know, Megan, if you have anything to add to that.
Great. Well, thank you again very much for taking the time out. And that draws our panel to an end. I'll hand over to Tom.